The consumer story in the US in 2025 is inextricably linked to the equity market story and by extension, the AI story. If you look at household allocations of their overall financial assets, households are holding the highest allocation to equities that they have in sort of recorded history and recent memory. And that may be because people are simply not rebalancing because they don't see any other alternative, regardless of the fact that stock markets have gone higher, the valuations are stretched. There isn't an attractive alternative, whether it's cash, fixed income, other options people have. Or it could be because investors are becoming more risk on and are allocating more to equities and chasing the market upwards. But the reason this is important, if we go to the next slide, is there's two things that really dictate how consumers decide to spend or save. The blue line on this graph is showing you net worth as a percentage of disposable personal income. And the black line is showing you in an inverted way, the US personal savings rate. And these two things tend to move in tandem. For most households, the largest asset they own will be their homes, but the thing that dictates the volatility in the value of those assets tends to be the equity market. And as the equity market moves higher and households feel wealthier, one of the things they'll tend to do is save less of what they earn. So you've seen these two things move up together. Household net worth has moved up and the savings rate has moved down. And that is one of the things that's really driving the consumer. There's also a consideration of what's going on with the labor market. We'll get to that. But for a lot of the consumers that really matter to the economy right now, the rising stock market has been what's driving the confidence to continue to grow that spending and to continue to save less of what they're taking home. So you can see on the next slide here, what's really important about this story, and I think it ties it together, is it's really the higher end consumers. Wealthier consumers, higher earners who are going to tend to be disproportionate owners of equity market in their personal assets. Those are increasingly driving the bulk of consumption. The top 10% of income earners now drive about half of overall personal spending. Not to say that the bottom 90% don't matter, because that's the other half, but we know that the sensitivity of that top 10% to things like what's going on in the labor market may not be as powerful, whereas the sensitivity to what's going on in the stock market may be the overriding concern. We've seen this in the past. This last slide here in this section will show that quite well. In the 1999, 2000, 2001 period, we had this very, very powerful equity market rally based on a lot of optimism about technology, specifically the internet. And then at the same time, we had this very, very powerful consumer spending growth story. And it was only just as the market was peaking that the year-over-year rate of retail sales growth also started to come down. There's a very strong correlation here between what the equity market was doing, it is a leading indicator for the economy, and what consumers ended up doing, because so much of what was driving consumers back then was the sense that they had become wealthier. And as that wealth tended to recede, they also changed their spending habits.